Hello everyone who's watching, welcome again to the future of real estate, post COVID-19 thoughts. To those of you who I'm sure already know, we've done a session just under a year ago at the heights of COVID-19 with Rob, who's here. Hi again, Rob. And Rob was very informative in terms of sharing his thoughts, what is real estate doing throughout COVID-19. Naturally, some time have passed since, and a lot of you have been asking me personally, hey, what are your views or what the views of the community is on real estate. So I gathered Adrian, Rob and Nir, who are part of our community and obviously have an incredible exposure to real estate. They do it day in, day out. And we'll ask them a few questions, what they think the real estate market is shaping post-COVID-19 and obviously the interesting markets we see in the economy going forward. So without further delay, I'll ask each one of you to introduce yourself. Rob, how about we start with you?
Sure. Thanks, Nir Shay. Look, my name is Rob Rayner. I'm the CEO and a major shareholder in our business, which is Corval. We're a funds management group that deals in real estate only, everything in private markets, none of it's listed. Everything is Australian-based real estate. We deal with institutions, wholesale investors, family offices. And we sort of hunt value and try and find opportunities, and when we do, we then present them to our investors in pretty simple to understand unlisted vehicles, and those vehicles sort of have a 5 to 7 year term. So of course we co-invest in everything we do, but we're sort of an Australian-based real estate commercial property fund manager that tries to find value more in the core plus space, less so in the core, where we can add some value. So that's what we do.
Thank you very much, Rob. Adrian.
Good morning. Thanks for organising this, Nir Shay. So Perth boy, born and bred, accountant many moons ago by profession, sole owner of a small property funds manager focusing on income and passive funds, solely in WA as well. We haven't ventured out yet. We invest alongside wholesale and sophisticated families and private companies. Over the 10, 11 years, we've been in and out of circa 40 investment funds. So we're pretty active. We're down at the smaller to medium end of the market, from single asset, single tenant to small suburban commercial shopping centres and commercial complexes. Interesting 12 months, but I'm sure this discussion will get into it very shortly.
Thank you very much, Adrian. And all the way from the US of A, Nir.
Yeah. Hi, thank you. Nir Shay, Denver, Colorado. We are a local residential developer and contractor, mostly focused on single-family homes and townhome projects. Most of what we do is infill. And we work with private investors and facilitate that around the Metro Denver area.
Thank you very much, Nir. Now, I'm going to start with a rather left field question, and feel free to take it in turn. Now, obviously, the last 12 months, as Adrian mentioned before, was rather interesting 12 months, both in terms of the economy and both in terms of COVID-19 and pandemic, which was a black swan event. So what I'm curious to know is, when COVID-19 started, what was your biggest fear? And has that fear materialized over that period until today, of course, right? Anyone's happy to take that one?
Look, I'll open the batting. Look, the obvious fear we had was, one of confidence and obviously health. And unlike the global financial crisis of 2007 or 8, which we still all, certainly I do, still very much remember, that was a financial-led crisis. This was a health crisis which none of us knew where it was going to go and indeed how it's going to end, and it still hasn't ended yet. There's still interesting comments, Nir Shay, you keep referring to post-COVID. We're still feeling as though we're still in the middle of it, or maybe post the end in the middle, but we're not out of it yet. And I think COVID in some form or fashion is going to be with us for many, many years. So we'll just learn to live with it. So it was a health thing which could go anywhere, and clearly people not dying from it was the obvious immediate concern for all of us. But if we then put our business hats and our financial hats on, our concerns were and still are today is what it's going to do for tenant demand and therefore rents and therefore values because the value of real estate is driven by rents and amongst all of that is incentives and downtime and letting up and basically what impact is it going to have on cash flows and therefore the ultimate value of the real estate and therefore banks and returns to investors. So it's sort of like a domino effect from that. And the way it's transpired is certainly, if I take a 30,000 feet comment, rents, leaving aside industrial real estate, which has been a net clear and obvious winner out of COVID, with the way people have moved to online shopping as opposed to in-store shopping. The strength of industrial has been the weakness of office and retail in some degree. So the impact upon rents has been clear. Rents have fallen and incentives have gone up. So that's no surprises there. But the more perverse outcome is that yields, or cap rates as we call it in the industry, have actually compressed as a general comment on the back of very, very low interest rates and banks still being open for lending and a very flat yield curve and capital still looking to get a return on it. And simply, income is a clear driver. So there's been no shortage of capital that's been flowing into the sector together with our Commonwealth government stimulus to encourage people to spend and borrow and keep things moving forward. So the net offset with rents falling and incentives going up, which in real estate sense is bad, has been more than offset by yield compression. So if I looked at our portfolio, June 2020 valuations to June 2021, June 2020 valuations to where they are now, perversely they're actually higher, despite rents being lower and incentives being higher. So it's that seesaw effect that we're seeing. We still are concerned about where rents are going to go and tenant demand and this whole work from home concept. The Sydney CBD is more and more busier day by day. It's been less busy obviously down in Melbourne with their effects of COVID, and I'm not sure what it's like over in Perth, Adrian, but I was over there for Easter and it was quiet. But this physical markets are coming back, and certainly a lot of the big space users in the US, I noticed some of the big investment houses are now saying, look, we're now coming back into the city. It's safe. Vaccination levels are increasing, and the work from home stuff is not ideal, and we want people back in the office. So that's going to help with demand and rents. But so it's been a sort of mixed master effect of it. But as I say, it's perversely, we were, I think, right on the fact that rents were going to fall and incentives go up, but we were wrong on values going up. And certainly any property that's got long-term leased income, like 10, 15, 20-year WALEs or lease terms, the yield compression on that has been significant. You've seen those assets jump up 15, 20, 30% in 12 months because of that annuity cash flow and therefore no holes in the cash flow, no for letting up. So yeah, that's sort of what we've seen and experienced, and I should probably take a bounce and let someone else put their views forward. So.
Thank you very much, Rob. Adrian, same question?
Yeah, look, I echo just about every sentence Rob said. So seeing some of the same stuff, or if not all of them, in Perth, WA. Just wind the clock back. It started COVID. Sitting back and trying to take stock and not get caught up in all the noise and all the media. But it was an interesting time, where the personal concern clashed with the business concern. Where on one hand, personal, you've got older family members. What does that mean with the COVID vaccines? And then you got family members overseas and their different rules and regulations. And then you've got the business concern. So I've never been involved in anything like that, but it was very interesting, and first time I've seen them clash, and we had to take stock of all of that. But yeah, just echoing everything Rob said, compression of these cap rates, interesting, very, very interesting. And just the concern with welfare and people moving out of the city, and different businesses. Some are doing really well, some are doing not so well. Getting to understand their businesses a little bit more, and ensuring that are aware of all the availability of government assistance. It's not everyone knows what they can and can't receive. So yeah, it was very interesting times, but hopefully we're through the thick of it. So it's interesting times, but there seems to be a lot of capital around. A lot of people are chasing a lot of income, and those long whales, like Rob said, they're getting hunted down very, very quickly. So yeah, the next 6 months, eyes and ears open, but it's going to be interesting times. Yeah.
Thank you very much, Adrian. Nir?
Yeah, so we mostly on the residential side, we've been seeing, we saw a few things. We also hold some of our projects, so we rent them out. What we were seeing, since our projects are mostly attached single family, we were seeing a lot of people moving out of the city, a lot of the more crowded multifamily, bigger buildings moving out and looking for bigger units. We're actually seeing, even within the buildings, we're seeing people prefer the 2-3 bedrooms over the 1 bedroom or the studio, with the whole, for a few reasons. I think one is just how everything is condensed in COVID, where you need to be more distance, and also the fact that people were looking to work from home, so they needed the space. So we were seeing that, and on the rent side, it was actually very, very good and very stable, even though the tenants have the right not to pay, according to the new forbearance laws and on rent and mortgages. But what we saw is that they're actually want to pay and want to have a stable outlook, and also we were seeing some asking for long term. They're a 2-year contract on residential rent, which is something we don't typically do, but we did offer it, and people once we started hearing about it, that people wanted it. So we were seeing that people were looking for stability. They want to make sure that they can kind of secure the rate for a little longer time. So on the rent side, we actually were very happy with how everything basically played out for the single family or single family attached type of product. On the development side, we are and still are dealing with COVID. What we saw, as you probably heard about, how lumber went up, which affects us a lot. I think yesterday it went down like 40%. It was crazy. Just a few days, it's corrected. But what we were seeing is our construction costs just dramatically went up. Copper has gone up, which influences both electrical and plumbing. So between lumber, electrical, plumbing, which are big for residential, all our construction costs went up to 30 to 40%. We were hesitant to continue projects, and we have projects in phases, but we decided to continue those that are in progress, that have foundation and undergrounds in place. Those that are not, after a lot of debate, we decided to sell a lot of these entitled parcels off. Typically our parcels are anywhere from 1 acre to 4 acre infill projects in the entire Metro Denver. And it seems like there's buyers. So obviously if there's buyers, they're optimistic about the future, and they're willing to pay top dollar for it, what I would consider. But we are a little hesitant to continue with construction, even though we are seeing a correction down. And really for us with residential, everything, just like Rob mentioned, it's about rents and commercial. With residential, it's about income. And we are not seeing income correcting with the rise in value. So that alone is concerning to us. At the end of the day, it's a calculation. Everything is driven by mortgages and income. So we are basically on the development side, we are liquidating some of the land. And also on residential, it's one of those holding land, and we hold land. Land does well in an up market, but it does not do well in a deflationary environment because of residual value, and does not do well in an inflationary environment because of residual value as well, because it does not leave a lot for the land when everything is inflated. So we decided to liquidate, be in a more liquid position, continue our existing projects, and kind of wait to see how everything plays out.
Thank you, Nir. You know, there's two themes that I'm kind of sensing through your responses. One is really returns and risk, and the other one is how consumer behavior may change going forward. And I'd like to touch on each one of them in turn. So the next question to the panel, and how, obviously with your experience and with your current exposure, how do you think the current environment affects the returns and the risk expectations from investors or of yourselves, right? So that relationship between returns and risk. Do you consider, or investor consider, now it's risky environment, so I'm happy to take a lower return, or vice versa?
Yeah, I think it's a sort of fork in the road. You know, like if it's a riskier asset, you know, like an asset that's got large levels of vacancy or expiries coming up, or you know, planning or development risk, or you know, delivery risk, or anything that's got the word risk in it has been amped up because of COVID. People are wanting more return for that, either the same level of risk or a perceived higher level of risk. Whether that risk is there or not, it's more the uncertainty that COVID creates, and therefore people are quite rightly, I think, and I put my own investor hat on, I sort of think, well, none of us know. Anyone that says sitting here today, they know what's going to happen in 3 months' time and 12 months' time and 3 years' time is making it up. So, so therefore, you know, in times of uncertainty, just human nature 101 says that your return expectations go up. And then the flip side of that is what I was saying before. If you've got an investment opportunity that is a very long leased asset with either government income or you know, high credit rated tenants under long-term leases with fixed rent reviews or CPI hedges in it, or both, you know, that's a flight to quality, and people are saying, well, look, that's less riskier, or less risky rather, so they'll pay higher for those prices, and therefore yields are compressing. So we've seen that. You know, some of the yields that we're now seeing that purchasers are paying for those very long leased assets, we would argue that maybe there's too much for a premium that's being paid for that, and therefore they themselves become a little bit risky by virtue of how aggressive the yields some of these purchasers are paying for those secure cash flows. And then if you layer in, you know, typical gearing of say 50%, you're buying a yield on a, you know, cap rate yield of you know, even say 4%, and that cap rate softens to even 4.25 or even 4.5 with 50% gearing. Well, just get your pad and pencil out or your computer out, and that impact upon your equity can be sometimes 30-40% just with a slight movement in cap rate with that level of gearing. So again, we think that's a risk that some capital isn't fully factoring in. I'm just thinking this cash flow goes forever, but of course it doesn't, and those lease terms become less and less, and therefore the cap rates in themselves should soften. So I think it's one or the other. You know, anything that's got uncertainty in it is being fairly and rightly priced for risk, and therefore values are lower. But the pure income streams with secure cash flows are sort of benefiting the other way. So it's and I think this will sort of become a bit clearer as we get through COVID a bit more, and we work out, you know, where rents are going to settle at and where tenant demand's going to be, and you know, we can then underwrite things with a bit more clarity. But when you're not sure, what may have been a 12-month leading up period for some office space or a retail store or something, you're now probably saying, look, it's 18 months or 2 years because we just don't know. And that therefore has a big impact upon returns and value. So.
Yeah, I see a lot of differences between the different type of investors. Again, so we're only WA based, but in WA we're seeing various different transactions happening, and the various different compression in cap rates is highly relevant towards the different type of investors. We're seeing a mix. I haven't seen the most activity like this in a little while, but we have you know, guys like us on the call, and then you've got you know, some institutions higher, and then you've got the a couple of friends pulling their money out of their super or equities and joining hands and transacting on property. in chasing the long whales. So we're seeing some astounding compression in cap rates, and then you see the same stock being bought, same type of asset being bought by, say, an institution, or so not an institution, say different various fund managers, and they're very different cap rates and different structure of the deal. So I've seen a little bit of choppiness, and people benchmarking various different returns off different things. So we're seeing some people just coming out of cash and happy for those long and slow, secured income. So it's interesting just watching the trades get and the stats going through. But yeah, like Rob said, in terms of the cap rate, where is it going to go? What are the premiums? Some things we're seeing trade at a very good value, and then some we can't see any value. Our computers are giving us the wrong information, or the other people buying it are using a different yardstick compared to us. So it's choppy. It's choppy. Normally, you see a direction, and everyone's heading the same direction in similarity, but now we're seeing various different transactions happening that we can't see sense in, and like I said, either we've got something wrong or they're using different yardsticks. So, but yeah, that's what we're seeing.
Thanks, Adrian, and I'll come back to your comment in a second. Your last comment, maybe they're using different yardsticks to measure returns or value, because I think that's a very important point, and I'll come back to it in a second. Nir, do you have any comments?
I mean, in terms of risk, I mean, we see at least at what we do as high risk now, for different reasons. I mean, one, construction cost is extremely high, so our margins are low if we sell, and we also build for rent. Like I mentioned, some of the projects we keep. We like to build at 150 basis points spread to what we think the market is for these build for rent small communities. We're just not seeing it. And once construction goes up, we're building to a very low cap. And we feel like if we don't see income going up to support this, we're too high for us. It's just too high. On the other hand, we are seeing, while that is happening, we are seeing a rush to residential real estate. So at least here in Colorado, but it's almost all over the big cities. I'm sure in Australia too. I looked at it a little bit, but especially in the big cities, that there's a rush which drives residential high. But then again, when you look at the income of the people that are actually renting or have to pay their mortgages, it's not going up. It's not going up at the same rate. So something's got to give. So for us, it's either we compromise on low returns, build with high risk and go to low returns, or let this, whatever this is, let it play out so the margins work. What might work against us is supply and demand, and then we're not building. The supply and demand drives prices up, but then you're not building for yield anymore. You're building for appreciation. So, and then especially holders, we don't like to speculate that much. We like the income. So so it was a tough decision, but we made it, and that's so we see it as high risk until something correct, and it might take a while. It's not something that I think it's not a matter of a month or two or 6 months. We need to see how things play out, but it might take a while.
Thank you, Nir. I'm going to go back to Adrian's comment about valuation and different, I think the phrase used is yardsticks. Is that correct, Adrian? Yeah. The comment I'd like to make is, I know the three of you obviously very, very well, and whilst you're in different subsectors of the real estate market, you have one thing in common, and you're very patient, and you're not rushing to do deals left, right, and center just because anyone and everyone else is in a rush. And sometimes it's tough to be that contrarian who's just happy to hold. And I'd love to hear your comment on this. Why are you so comfortable being patient?
Okay. But yeah, the phrase we use in our office is opportunities. So these things they come and go, and there are various different opportunities. We look at them and see if we can find value, and if there's any room for us to do what we do. And we can't take them all. So if they make sense, we will look at them, we'll get involved, and we'll roll our sleeves up and have a look. But if they don't make sense, we don't try to make it make sense. They're just opportunities. Let that one pass. There's plenty of things to do. So, but yeah, in terms of value, again, interesting topic. But there's all different types of value. But just going back to the question in terms of yardstick, we're seeing various different investment partners or other buyers and sellers, if you will, using different types of yardsticks in terms of what they see value and the reasons why they're buying or selling, and or what they're using as guidance according to base their decisions on. So there's all different levels and various different families and private entities. Some are looking at the differences between the liquidity, like Rob touched on before. Some people value it, some people don't. That's a whole nother discussion. But some people are benchmarking off equities. Some are looking at cash rates. Some prefer to sit on cash, and long-term and short-term whales with the leases and what their view is in terms of rents. So some people prefer some lower whales because they see in various different markets rent uptick. So it's an interesting discussion, and every opportunity is a different opportunity. I'd love to say it's a simple model and you tick 3 or 4 boxes and it gives you the answer. Unfortunately, property with multiple tenants in different industries and style of assets, it's an interesting discussion that requires rolling up the sleeves. So yeah, that's mine.
Thank you, Adrian. Rob, I know you are very patient. Do you mind to comment on that?
Oh, look, I think patience is a relative thing. Yeah, like my patience might be very different to anyone else's, but the way I answer the question, which is a good question, is quite simply we're not sure. We don't know. And when human nature 101 is that when you're not sure, you tend to just be a deer in headlights. You just don't do anything. You don't run. You just wait and just see where it's going to unfold. And the thing that's tricky is that we've never been, well, certainly in my working career, which in real estate, which is now sort of 35 odd years, I've never seen a sustained very low interest rate environment that we've now got. There's going to be some important numbers coming out of the Fed tonight, our time certainly, with some reads on inflation, and that, if it goes the wrong way, could, for the first time, start to spook bond market yields. And the commentary out of the Fed has been, we're not even thinking about raising rates or whatever they say. And so the market's interpreting that rates are going to stay pretty much like next to zero for at least 3 to 5 years. And you put that into any sort of underwriting, it allows for some pretty punchy prices to be paid and some pretty spectacular returns compared to what is otherwise the risk-free rate of return being cash or bonds. But if the reads coming out of the US Fed tonight is suggesting that maybe inflation, and I think it's accepted that there is going to be some uptick inflation in the short term because of all the stimulus that's been pumped in, but all of the commentary that I'm reading about from the RBA here and the Fed and stuff is it's beyond the waves, beyond the short-term waves. It's going to be very benign again. So the market seems to be almost ignoring any short-term concerns around inflation. But if those short-term concerns become reality, that inflation is starting to go to uptick, well, all of a sudden that's going to have some pretty big knock-on effect with risk-free rates of returns and cost of debt, et cetera. So we've got this very benign interest rate environment. Plus, the other comment that I'd make is that the world's never been more global than what it is. Take this conversation. Nir's sort of listening into a conversation between 3 Australians, and I'm listening with some interest, a lot of interest, in fact, with what's happening with residential markets in the US. So connectivity and access to information and flow of capital has never been stronger and will only continue to get stronger. So whilst I may look at, you know, a commercial office building here in Sydney at $25,000 a metre and a yield of 4%, think that's expensive. Someone else with the same amount of capital sitting in London or Hong Kong or Tokyo or indeed New York might look at it and think, well, that's cheap compared to the same returns we can get on that same style of real estate in our local market. So there's nothing stopping them buying that same piece of real estate and being comfortable with a return that we think is marginal, which they think is good. So, and real estate, you know, if you think about it as purest form, real estate, just because someone buys something doesn't make them the smartest, just that they're prepared to pay the most and accept the lowest return or be happy with that return. So if we sit out and be patient, to use your words, Nir, and pass something over, someone else might jump in and pay it, and therefore we could be waiting for a very long time. But that's okay. But you know, we're all competitive mammals as well. We all want to get on and do things. We don't just want to sit around and wait for the sky to fall forever, because guess what, it may not. So yeah, we don't want to be all chicken littles, but we don't want to be super brave at the same time. So I get back to what I said at the start. If we're not sure, you tend to do nothing. But there's a lot of circles around the edge of what's happening with interest rates and flow of capital, and you know, what's driving that. So yeah, I just think the next, you know, short period of time will be pretty interesting, particularly with my biggest concern is, and still has been, is inflation, and what that then has upon all sorts of asset classes, not just real estate, because it will drive the cost of debt, and it will drive therefore exchange rates, it will drive risk-free rates of return, and off we go again. So yeah, we just need to be watching for that. So,
which leads me to the next question. It's interesting you mentioned that, and I was going to ask all of you, which obviously a lot of people watching this have that in mind, and the one word, the highlight of the last month, really, if not more, is inflation. So how, and I think Rob, you touched on it a little bit now, but how do you think inflation will impact the real estate market, or at least your sector of the real estate market?
So I'll just mention our view. So you know, some people say, oh, there's not a lot of inflation, or it's going to be a bit of a bubble. It's interesting, but right on the coalface, I try to buy a barbecue and there's no stock. You try to buy a car, it's a 9-month wait. So you know, total Land Cruiser price has gone up $40,000. They've changed the model, but what I'm getting at, there's more and more bikes, there's more and more you cannot buy this equipment. Now that might be a logistics, might be increased, you know, so logistics issues, so less supply and higher demand, obviously COVID, but prices are rising, and that's right down at the cold face. So inflation is definitely running. There's a lot of stimulus in the air. It feels in WA that a lot of people have come into a lot of money, and nobody wants to hold on to it. That's what it kind of feels like. Everyone is buying lots of stuff. There's a lot of transactions happening. So look, we obviously waiting for the Fed notes as well. It's going to be interesting. We're aware of what the Fed and the RBA say about interest rate. I think it's you know, going to be a bit of a bubble. The question is where it goes from there. But so from once the stimulus started issuing, we started changing some of our lease mechanics to you know, CPI or fixed rate, whichever is higher. Everyone assumes the CPI rates are going to be very, very low. So it's going to be interesting what happens in the future and which one wins. But yeah, eyes open. But I definitely think we're in for some inflation. The question is how long it's going to stay around for.
Kind of what I'm seeing with this is I do think we are going for inflation, or probably our stagflation 70s style economy. But I do think from kind of what we follow and see that we're probably going through some sort of a deflationary correction. It might be a small one, but we're seeing eventually this liquidity, all this stimulus coming out. Eventually it's gonna die down. That's what we think, at least. And eventually, and one of the most important things to understand about it, it's all debt. So all this growth, it's still debt, and debt needs to be serviced. So eventually, kind of what we're seeing is we're definitely understanding that we're going into an inflationary environment. The question is, are we going straight up now, or are we going through some sort of a cleansing, a cleanup on the way up there? So it's hard to know, but we're kind of in that camp of some sort of correction. It might be small, it might be fast. I mean, it could have been a big correction if the Fed acted very, very fast with COVID, and it kind of stopped it, but it stopped it with trillions and trillions of dollars. Next time it happens, I think they're going to do it again, and they're going to print more. There's no way out of this, basically. I don't see a way out of the Fed raising rates. The US is at 28 trillion now in national debt, and it's just rising. The deficit is 4 trillion this year. There's only so much taxes, so I think taxes are going to go up. But I think again they're gonna print a lot. In general, I would say that real estate acts well in inflation, because real estate at the end of the day, it's land, but it's composed of labor, which is influenced by inflation, and composed of commodities. So although up in inflation, and real estate is an inflation hedge. The returns is another question. You know, if we're going to have the income to support it, we will see. If I think residential will have at the beginning, it's probably going to lag after commercial. At the end of the day, all these companies that were kind of holding back prices are now going to start to raise prices, from what we're seeing. And because their prices are going up, they're going to have to support their businesses. They're going to have to raise prices, and by them making more, they'll be able to support their workers and income, and that's how that flows. So in terms of the return side, that's our concern. In terms of the valuation, less of a concern than inflation.
Thank you very much, Nir. Now I'm going to change the direction a little bit of the conversation. Obviously, the last year has been very interesting to us, and I would be very curious to know whether you see consumer behaviors change in, I guess, your subsector. For example, Rob, I know you invest in office buildings. Has post COVID-19 impacted the way offices are looked at? I know we discussed briefly about it before. You know, building codes, etc. Adrian, I don't know, with retail or other stuff that you're doing, and Nir as well in residential. Do now people look for the home office? You know, they don't want 4 bedrooms, 2 bedrooms. Has that changed because of that environment? Because I suspect that will be the more attractive investments as an investors going forward. And I'm very keen to see how what you think about that.
Sure. Okay. Well, maybe. You know, I might sort of restrict my comments to, say, commercial office space, because, you know, whilst we've got views on retail and industrial, it's certainly not the core of the backbone of our business. So, what I would say in relation to office is that I think the whole notion and concept of, is office space dead? Why do we need to come into offices? We'll work from home permanently. I think that's fanciful. And I don't see that as sustainable, because human beings are social creatures. We like to interact with each other and be around each other, learn from each other. You know, I just don't see how that's a longer term solution. But what I do see is, I think the 5 days a week in the office is permanently gone, and I don't see it coming back. I think the model is going to be, you know, either, you know, some companies will be permanently not in offices, you know, that's more like tech type companies, and they lend themselves to that. But even then, I question how sustainable that is. But I think for 90% of office users, they're going to be, you know, working from home maybe 1-2 days a week, and in the office 3-4 days a week, or some variant of the same. But I think that's a good thing. Even though we're commercial landlords and we'd like to see more people in the office, the reality is that technology, just what we're doing now, allows us to do that. And I think and if you're not offering that flexibility, someone else is, and you'll just lose talent, and you'll end up with what's left over, and, you know, you just got to move with the times. But what I would then say in terms of the space itself, it clearly needs to be designed to allow for people to sit efficiently and apart, and you know, have regard for, you know, the distancing, But I think the office will also need to cater for different features, whether that be the way it's built, the way it's amenities that's on offer within that, and also the locations in that space. I think there's going to be a shift to I think whilst the CBDs are still will always be the main space users, I think suburban office will come out of this reasonably well, in the sense if it's well designed office space on public transport routes close to where people live. That's got more appeal, because you don't need to necessarily pay high rents and get into the city and fight the congestion and with all the parking issues that go with that, etc. So I think commercial office space, as long as it's of a certain standard, will be a winner. But there'll be a lot of office space that will become obsolete because it's just so old and so inefficient, and it's in not great locations, and I worry about that space, and that could well be reconverted to residential or different users, or multifamily or built to rent or whatever. But the other side of it is that from a development side of things, I think you're going to be pretty brave to go and develop more office space now with the vacancy levels where they are and the level of sublease space that's available. So that puts a natural stabilizer on it, and I think we're already starting to see vacancy rates within all of the capital cities around Australia starting to decrease, some quicker than others, and the level of sublease space starting to also similarly decrease. So it will take some time to work through, but I think what's going to amp it up and help that will be more and more people are getting back into the cities, or working, not wanting to work from home permanently, and also there will be a crimp or a supply on new office space coming in, so maybe that take up will be quicker than we think. What I do know is we always get it wrong on the upside and always wrong on the downside. We always think things are worse than they are. We always think things better than they are. It's always somewhere in between. So I think vacancy levels, both direct and indirect, will come down, not quickly, but I think quicker than most people think. And of course, as tenants, you can't go to a landlord and say, look, well, my workers only want to be in the office 3 days a week, so we still want the same amount of space, but we pay 60% of the rent. That just doesn't work. And for most businesses, the biggest cost is not so much rent, but it's people costs. If you've got 10 people at an average salary of 100 grand a year, that's $1 million a year. You pay nowhere near $1 million in rent. So your biggest cost is people, and you need to be able to sort of house them in space that's efficient and works for their needs. And if that means that the rent's still paid, and our experience is across all of our tenants, across all of our properties, and we've got about $1.5 billion worth of real estate, is that in the main tenants are paying the rent, and in fact not in the main, almost without exception, paying the rent, whether they're using the space or not. But they need that flexibility to be able to offer that to the employees. If indeed they want to go into somewhere to work, they can. So it's sort of, no doubt it's going to change, and it will have some impact, but again, it's still a wait and see approach to it also.
Rob's comments resonate with us as well. We don't own any assets in the CBD, especially office, but we've seen a lot of a lot of tenants moving to suburban locations for exactly the same reasons as Rob mentioned. And in our commercial shopping centres or commercial hubs, we're seeing more requests for offices for the smaller to medium businesses closer to like the transport and where they live, like Rob said, and across the road from major shopping centres with all the amenities and more car parking, more flexibility. So we're definitely seeing a trend in that in WA. I'm watching, or interesting to see obviously a lot of the businesses are allowing the flexible work arrangements, or some are not in the offices at all. I'm interested to see over the next few years in terms of the demand for office space. It wasn't so long ago when everyone was trying to cram more people into smaller spaces. It's going to be interesting to see if that goes the opposite way. So the demand might be demand for people in offices might be less, but the demand for spaces is the same because everyone's got a little bit more space, so or amenities. So we're watching that space. But yeah, the suburban markets are definitely increased in activity in offices, or especially a lot of inquiry. Everyone's looking at it as a second option before they renew their leases. So But yeah, I think lifestyle is a big thing now. It's been a big, everyone's come through COVID and had a bit of a taste at, working from the home office or suburban locations, and there's pros and cons. It's interesting to see how the numbers work out in terms of everyone's productivity and hours worked. My guess is, I think it's less hours worked. Some people's productivity has gone up and some have gone down, but squeezing that little surf or a quick run along the park, I'm looking at that in the next couple of years to see where it ends up. But yes, we are social beings. Everyone loves a chat and a bit of a brainstorm and a bit of a whiteboard session. So that's important. I don't think that's ever going to go away. But yeah, interesting stuff.
Yeah, I'm kind of thinking about what you guys were saying on office. I'm also very interested to see where it would go. I think creative idea. I've seen creative ideas of mixed buildings. I've seen those in Israel, which are office and residential in the same building, and I kind of think this might kind of bring new things to that. I also agree that I think it's not gonna. I mean, we are seeing on the first of all, to answer your question, we're seeing people moving from smaller units to bigger units. If you have a yard, it's a plus. If you have balconies, it's a plus. So people kind of want the space and are looking for bigger homes. And we typically hold the bigger types of homes. And we're not talking about grandiose. We're talking about just not the 2-bedroom, 1-bath. On the residential side, we're talking about just a bigger 4-bedroom, 2, maybe an office. We have those too, and we're seeing that. But working from home is obviously it's an advantage. I mean, I'm speaking to you now, and like my son is knocking on the door, so there's also disadvantages. And I really think it's at the end of the day, for companies to be productive, if there's going to have to be something of a mix at least, or even going back to what we knew of an office, maybe not as dense. And also what we're seeing here at least is that there's a lot of support right now with unemployment. So there's unemployment that's paying more than minimum wage or around minimum wage, and people just rather not go to work. So I really think at this very short term, it's an employee market, but I think that's going to change. Eventually, reality is going to sink in, and everybody's going to have to, just find a job to survive or adapt to survive. And for companies to be productive, there's only so much you can do, even with technology. Other than the social aspect of it, I think I look at it more as productivity, and you're just more focused when you work in an office environment, in my opinion. So we're kind of seeing the demand, but we're also understanding that it's good to have the bigger units. We always liked it. We liked it because of family, because a bigger family stays longer in a unit versus a couple that you have high turnover rate for residential when it's just a couple versus a couple with 3 kids. But now there's another aspect of the home office, which it's gonna somehow work all together. But I mean, pretty much that's what we're seeing, and I'm kind of curious to see if there's, with office, if it's going to transition to kind of a work-live building or something else. We'll see. But yeah, that's kind of what we're seeing on it.
Just to add to what Nir was saying, and look, maybe I'm a bit cynical, but it's interesting. You read these surveys about people working from home, and there's global office surveys, and it's no surprise, it's no coincidence that the days of the week that people are most happy or prepared to work from home happens to be, guess what, a Monday and a Friday. Happy to go into the office on a Tuesday, Wednesday, and a Thursday. So, I think that sort of says something about sometimes the mindset of people working in inverted commas from home, and maybe the sales of tracksuits and stuff are going to increase a lot with people working from home and stuff. I think there's a little bit of just, a little bit of the mickey being taken here. And, I think the human race, and they're all competitive mammals, it it sort of stabilizes itself pretty quickly, because what you're going to find, I think, and we haven't seen this start to unfold, but it's the next iteration I think that will happen, is if people are saying, you know what, I can actually do my job from home 5 days a week and I no longer need to come into the office, but other people within that same team or same group are, employers. And I'm an employer, but I have great, we value our employees very highly. And for me, all of our employees are pretty much, we have been back in the office almost full time for quite some time. But what you're going to find from some employers are going to say, well, you know what, well, if Larry or Mary wants to work from home full time and the rest of us are in here, well, I'm currently paying Larry or Mary in our case, an Australian-based wage, which for that sort of job, if it can truly be done from home without being in an office environment, capitalist employers are going to start thinking, well, maybe I can get that same job done from, let's just say, other parts of the world for a fraction of that cost. It could be 10 grand, 15 grand. So there's a massive saving that can sort of come out of that by saying, well, look, okay, you show me this job can be done from home. We'll let that person go in Australia and save ourselves 80% on our employee costs and ship that job off to another part of the world. Well, I'm a bit of a puncher. I bet you that person will find a reason to come back in the office quick smart if it means they're going to lose the job. So all of a sudden, working from home is less attractive if I don't have a job. And the other side of it is that, if we're all working in teams and there's a team of 10 people and 2 are at home and 8 are in the office, the 8 are in the office are getting sick and tired of constantly having to set Zoom calls or have phone hookups just to keep the other 2 in the loop, and they'll quickly become irrelevant. And when it comes time for REM reviews and bonuses and cutting up the pie on things that happen and stuff, well, the 2 at home, just the sheer reality of it is they're going to get less of the pie and they're going to get a little bit bent out of shape over that. So they'll find a reason to get back in the office. So I think there's all these stabilizers that will sort it in time, but there are legitimately some jobs that can be done from home that don't need to be done in an office. But the danger of those is how sustainable is that in a much higher employee labor cost environment compared to other parts of the world. And the unions will have something to say about that, and there'll be all sorts of things that'll lark up, and you'll see it on the news each evening that this employer's just shipped 30 jobs to wherever, and these people have a job, and I can just see it all now. So it's there's lots still to play out of it, and that's why I'm not super bearish around people staying at home and working in the offices. Like I've got plenty of people that I know that are just jack of it bad enough that they're just gagging. They just want to get out from home, and even made worse when their partner or the kids head off to their jobs and the kids go to school and still stuck at home with the dog. They get a bit sick of it after a while. They want to be out and around people and doing things. So I think there's enough stabilizers that's going to get people back away from home into shopping centres or office buildings or doing what they do back to what we were before. But there will be a level where maybe that, as I say, 1 day a week you work from home, which, as I say, I don't think is an altogether bad thing for yourself.
Thank you, Rob. Now, before we conclude the session today, I'm going to ask you a question. Let's assume our community is primarily family offices, and if you're a family office or even a high net worth individual, in these times of interesting times, rather, I was going to say challenging, but it's not necessarily challenging. What tip would you give someone who wants to invest in real estate?
Various opportunities come and go. Keyword there, opportunities. In terms of various different investment strategies, make sure you understand what you're investing in, and that makes you most feel comfortable with. And it's the sleep test. If you can't, I'm very big on the sleep test. If I wake up in the morning and the sleep test hasn't passed, I don't know the formula, but it doesn't pass. But there's obviously various different investment partners with different views, like we said, liquidity and length of term. We like long-term, stable, boring investments that pass the sleep test. Obviously, look at the various different portfolios that you have and what fits with the family and what the family requires. There's obviously every different family's got different requirements. Long-term, short-term, medium-term, and different skill sets. So my last comment is keep it simple, make sure you understand it, and work with people that you know, trust, and respect. So that's my comment.
Thank you, Adrian. Nir.
Yeah, I mean, I would say There's a lot of moving parts now, so it's a good time to observe. If you want to be extra cautionary, it's a good time for to have some liquidity position for either scenario, whether it's an opportunity if you feel more adventurous, or a defense strategy if you are worried. And I agree with Adrian. I mean, there's always opportunities. Even now, there's always opportunities, but it's you just have to be cautious and fully understand what you're getting into. And yeah, and it's okay. It's okay to wait and observe. It's not we don't always have to be doing and producing. Sometimes it's a good thing to see where things are heading.
Thank you, Nir. Rob?
Look, I think, the comments about Adrian and Nir are spot on. There's probably not a whole lot that I can add, but other than just, do your due diligence properly and in detail. Don't just accept what agents or others are saying as being gospel and true. Think about risk in every fashion that you can, and focus more on the downside than the upside, and think about what can go wrong and what happens to that in some sort of return analysis if interest rates were to rise, or you'd lose tenants. Just think about risk more than ever, because I think risk is really the focus for us, and always has been. And think about risk in a different way. COVID's going to introduce risk factors that none of us were thinking of pre-COVID. But in particular, how people work, the demand for space, the location of the real estate, how's the real estate designed to allow people to work, efficiently, etc. Before we sort of, whilst they're important, I think they're more important now. So it's really do your research, don't be rushed. To Adrian's point, invest with people that you trust and know, and don't be afraid to ask questions. The questions that you want to ask and choose not to will be the questions you regret later on that you didn't ask. So just take your time, invest carefully and cautiously, and focus on the downside more so than the upside.
Thank you very much, Rob. Not surprisingly, similar themes in terms of the tips for people who's listening. And with that, I'd like to thank all of you for participating in the panel today. And to those of you who's watching, I hope this was educational for you. If you want to be contacted with any of the panelists today, Adrian, Rob, Nir, please feel free to contact myself or anyone at Koenig Heritage, and we will put you in touch with them. And with that, I say thank you very much to our guests, and we'll see you the next time.